Okay, so we are now looking at one of the cardinal topics in financial and management accounting, which is now called the cost volume profit. All right, this is also called CVP in short. So in CVP, this topic is found in both management theory and practice, and as well as in financial management accounting. Now, there are a number of considerations as we look at the CVP. All right, so now this one, the first aspect we need to look at is on the CPU, which is the contribution per unit. Okay, so the contribution per unit is simply the difference between the selling price per unit and then the variable cost per unit. That is the term contribution. So contribution does not take into the fixed cost per unit of a product. It only looks at the sales minus the cost of sales, or selling price per unit minus the variable cost per unit. So the formula here, the CPU is equal to the selling price per unit, then minus the variable cost per unit. So we have a term called the contribution per unit. Now, under contribution to sales percentage, we are going to say contribution over the selling price or sales multiplied by 100%. This is about what we have. We have the selling price minus variable cost, which is a contribution. So this one is our contribution over the selling price per unit multiplied by 100%. All right. So getting down to the other one, which is a BEP, which is a break-even point. So this is a point at which the firm is neither making profit nor loss. So the short form of this is the BEP, point at which the total revenue of the business is equal to the total cost of the business. This is about the break-even point. Now, at break-even, we are saying our total revenue is equal to the total cost of the business. So total revenue is equal to total cost. This is about the break-even point. So it is actually meaningless at this point because our revenue is equal to our cost. So we are not doing anything to management. We are not doing very okay here because the essence of a business is to make a profit. So for every business, we need to make profit. Now, it is meaningless that our revenue and our costs are the same. So, all right, it is insignificant. But of course, it is just the mirror, an eye opener to see that, okay, now we can improve a little bit so that we start making profit because you know that the revenue and the costs are the same. Now, the total cost of the business is equal to the total fixed cost plus the total variable cost. So every business has two major costs. We know the fixed cost is the cost that the firm can incur regardless of production. But if we look at the variable cost, it's a cost that the firm will incur as they produce units of a commodity. So the more they produce, the variable cost will keep on varying depending on production. So this is about the total cost. All right. Now, getting down to the break-even point in units. Okay, so break-even point is equal to fixed cost over the selling price per unit minus the variable cost per unit. This is when now you get the break-even point. So it's a fixed cost over the selling price per unit minus the variable cost per unit, meaning that we are simply saying it's a fixed cost over the contribution per unit. Okay, so this is only the aspect of the break-even point. So it's a fixed cost over the contribution per unit. Okay, so this is about how we are getting the the break-even point. Okay, so we have the fixed cost over the selling price per unit minus the variable cost per unit. So we are getting the BEP. All right. Then we getting down to the other one. So BEP is equal to fixed cost over the contribution per unit, which is this one. Okay. This is only the break-even point. Now we are getting down to a break-even point in kwacha is equal to break-even point in units, then multiplying by the selling price per unit. So that's a break-even point in kwacha. So it's equal to the break-even point in units, then multiplied by the selling price per unit. All right. Of course, like I mentioned, that at BEP, the firm is neither making profit nor loss. So we are going to now migrate from the break-even point to margin of safety. So margin of safety, this is where the firm is producing units of a commodity above the break-even point in order to generate profit. So now here, we know that it's meaningless for us to be at BEP. So we need to migrate from the break-even point to margin of safety, okay, where the firm producing units of a commodity above the break-even point in order to generate profits. All right, so these are cardinal points that we need to know as we look at the margin of safety. So the firm producing units of a commodity above the break-even in order to generate profit. Okay, now we have to look at what is margin of safety in units. Okay, so margin of safety in units, we are going to say is equal to, okay, so margin of safety in units is equal to Q minus the BEP. So Q minus the BEP is the margin of safety. Okay, so our Q is a particular units to be produced is our Q, and then this one is the BEP in units. Okay, so margin of safety, which is MOS, we are simply saying is equal to Q minus the BEP. Q, we are simply saying variable units to be produced and sold. Okay, so Q minus BEP, where Q are variable units to be produced and sold, and then margin of safety in percentage is equal to Q minus the BEP, then you divide by Q, then multiply by 100%. So this is margin of safety in percentage. So the margin of safety in percentage, we are simply saying we are now producing units of a commodity above the break-even point in order to generate profit. All right. So this is only the margin of safety in percentage. So Q minus the BEP over Q will multiply by 100%. Now, units to be sold in order to achieve a target profit. So it is Q is equal to fixed cost plus the target profit over the selling price per unit minus the variable cost per unit. So this is the units to be sold in order to achieve target profit. So it is fixed cost plus the target profit, then over the selling price per unit minus the variable cost per unit. So this is about how we get to the units to be sold to achieve a target profit. So these formulas are supposed to be understood. It's supposed to go through these formulas as we look at the cost volume profit topic. That is very cardinal topic that comes in financial management accounting. Same was in management theory and practice. Okay, so these are the formulas that are involved as we are looking at these this topic, which is the cost volume profit. All right, so we can get down to an example. Of course, I have to explain the assumptions of the CVP. Okay, so we can explain the assumptions of the CVP, and then also the other things that we need to go through, the limitations of the BEP and all that. Okay, so units to be sold to achieve a target profit. We have given the formula here. The margin of safety in percentage, the formula is there. Margin of safety in units, the formula is there. And then the break-even point formula is there. The total cost, the formulas are there. So you just need to apply. The contribution per unit, the formulas are there. So you just really need to understand these comparisons. So there are just few formulas that need to understand. And all right, so just about these notes to be shared. All right, then we get to an example. Now, this example, we can get to a detailed example of an exam. All right, so we can go to an exam type question. But before that, let's look at an assumption of CVP. What are the assumptions of CVP? So the first assumption is that the selling price is the same for all quantities sold and produced. So the selling price is the same for all quantities sold and produced. That is number one. Okay, so that's one assumption, the first assumption there of CVP, cost volume profit. Then the other one, we are simply saying, the second one, we are simply saying costs and revenue functions are always linear, meaning that they are straight lines. Okay, so costs and revenue function are always linear. So we are simply saying they are straight lines. Okay. Then the other one here is that we are simply saying production technology is unchanged. So that is the other assumption of the CVP. Then getting down to the other one is that there is perfect information about the product to be produced and sold. All right, so this is the other assumption of CVP. So the examiner would ask about the assumption of this CVP, which is cost volume profit. All right, so revenue and cost, they are linear, which means they are straight lines, and the selling price is the same for quantity sold and produced, so meaning they are not changing the selling price for given product. All right, now let us look at what are the limitations of the BEP. Okay, let's look at the limitations of the BEP. It cannot be computed when the selling price per unit and variable cost per unit are not given. So that is a limitation. Okay. Then it is affected when one of these variables change. That is when the total fixed cost, because we know at BEP we have BEP is equal to okay, so BEP we have equal to fixed cost, then over the selling price. So SP, which is selling price per unit, minus the variable cost per unit. So meaning when one of these parameters change, then the BEP is actually affected. So it is affected when one of these change. Maybe the fixed cost, if it changes, or the selling price changes, or the variable cost per unit changes, then it is actually affected. All right, so this is about the other limitations of the BEP. Now we get to the other one. The limitation for this one is that it is meaningless because at this point the firm is neither making profit nor loss. So that is a limitation because the firm is neither making profit nor loss, meaning it is meaningless. All right, it is meaningless at this point. So we are looking at the limitation of BEP. They expect a question of that type in an exam. And then we also look at the assumptions of the CVP. Those are cardinal ones. So now we can get down to an exam type question where we look at a detailed example. Okay, so all right, we can have this example here where we are saying ABZ company produces units of the commodity. So what is important is for you to understand the catch. The concept is what is important. The question may change in an exam depending on what the examiner would actually come up with. Okay, so ABZ company produces units of the commodity. Okay, so produces units of the commodity. Okay, so ABZ company produces units of the commodity, and the selling price is 20 per unit. The variable cost per unit is at 15 kwacha. The total fixed cost is 250,000 kwacha. The budgeted units to be produced and sold is 70,000 units. So this is our Q. These are units that are budgeted to be produced and sold. So we have the 70,000 units. All right. Now required, calculate the contribution per unit and the break-even point in units and in kwacha. That's number one from this information given here. All right. Now the other one is calculate the contribution to sales percentage. Okay. Now the selling price per unit is increased by 25%. Calculate the new break-even point in units and in kwacha. So depending on that, then calculate the margin of safety when the selling price per unit is at 20 kwacha and variable cost per unit is at 15. And then the margin of safety in percentage at this level. All right. So from here, we know the selling price is at 20 kwacha, and then we have the variable cost per unit is at 15 kwacha. So we can find the margin of safety based on the information that is given here. So we just really need to understand the compositions of the question in an exam that you need to apply now. Then we start resolving the problem. Then find the target units to be sold to achieve profit of 150,000 when the selling price is at 20 kwacha and the variable cost is at 15 kwacha. Find the target units to be sold to achieve profit of 150,000 when the selling price is at 20 kwacha and the variable cost is at 15 kwacha. State the assumptions of CVP. Explain the limitations of the BEP. So these ones, they are already explained the assumptions of CVP and the limitations of BEP. So now we can start answering the first part of the question. All right. So from here, we know that our contribution per unit is equal to selling price per unit minus variable cost per unit. So contribution per unit, the CPU is 5 kwacha. That is the contribution per unit. Selling price per unit minus the variable cost per unit. Then the BEP is equal to fixed cost over the selling price per unit minus the variable cost per unit. So a BEP is equal to 250,000 divided by 5. So it is just the fixed cost, okay? Then over the CPU, which is the contribution per unit, which is, so now you get the BEP. All right. So this is about what goes on. So we are getting this one as our BEP. So we can now get to the answer here. We are getting 250,000. Then we are dividing it by 5. So we are getting our BEP as 50,000 units on the first part of the question, where we are looking at the contribution per unit and the break-even point in units and in kwacha. So the CPU has been calculated as 5 kwacha. Then the BEP is 50,000 units multiplied by selling price per unit to find the break-even point in kwacha. So that is of units. What is important is the formula to understand as we get to the BEP. So what is the break-even point? So the break-even point in kwacha is 1 million. Getting down to contribution over sales percentage is a contribution over sales. So contribution here, it is the difference between the selling price per unit and the variable cost per unit. So which is a 5 here on top as a numerator here. Then you will divide by the sales. So selling price per unit is 20 by 100. So meaning that we are getting 25%. All right. Then we're getting down to the other parameter here. If your selling price per unit is increased by 25%, so we can find the new selling price that has increased. So meaning the increase here, it is 25. We can do it 1 by 1 over 100 multiplied by 20. So meaning our increase here is giving us what? So the 0.25 times 20, which is 5 kwacha. So the increase is 5. So the new price will be 25. Okay. So meaning new selling price will be increase is 5 plus the odd price, which is giving us a 25 kwacha. It has increased. So we need a tip. The selling price has now become 25 kwacha because the odd price was at 20 kwacha. So use a new break-even point in units and kwacha. So Roman numeral number 3 is what we're looking at. So the new break-even point in units is 25,000 after the increase in price. All right. So here we are getting 25 minus 15, which is 10, dividing by that is 25,000 units. And the break-even point in kwacha will be break-even point in units, which is 25,000 multiplied by the selling price per unit of 25 kwacha. So this is giving us 625,000. That is the new break-even point in kwacha. So this is the new BEP. Okay. So new BEP in kwacha. Okay. So this is about what is going on here. All right. So let us move on now to get to the other questions. All right. So the other question says, calculate the margin of safety when the selling price per unit is 20 kwacha and the variable cost per unit is at 15 kwacha. The margin of safety, like I mentioned, is a point at which the firm, they are producing units of the commodity above the break-even point in order to generate profit. So here, this is a point where the firm is producing units of the commodity above the break-even point in order to generate profit. Because the firm, they know that it is meaningless for them to continue operating at BEP, so they should migrate to margin of safety so that they start realizing a profit. All right, now getting down to margin of safety at this point, our margin of safety when the selling price is 20 kwacha and then the variable cost per unit is at 15 kwacha. So our margin of safety is equal to, we need to check one thing in this question. The budgeted units that to be sold and produced, Okay, there are 70,000 units. Now, at the time that the firm, the selling price is at 20 kwacha, and then the variable cost per unit is 15 kwacha, the break-even point in units was 50,000 units at this time. Okay, so it was 50,000 units using this information, 15 kwacha, 20 and 15. All right. Now we are getting down to our margin of safety. So margin of safety is equal to, the formula is here, margin of safety in units. We are simply saying it's Q, which is better than units to be produced and sold, minus the BEP, which is the break-even point. Then getting down to the difference between these two is 20,000 units. So these are additional units that the firm should produce if they are to start realizing profit. That is what
you said the 70,000 is the units to be produced?
It is the units that are budgeted. In the question, they would give that one always in every exam paper. They would give, so it is the 70,000 from the question, the budgeted units to be produced and sold that the company budgeted, the ABZ company budgeted that they would produce the 70,000 units. All right. So meaning every time the Q, the units budgeted should be more than the BEP. Always in every other question paper, you'll find that the budgeted units should always be more than the break-even point that you found. If you find if it is less than that, then you just know that there's a problem in your computation, please. All right, now getting down to the other question, because we're still looking at question number 4, Roman numeral 4, when the margin of safety, when the selling price is 20 kwacha and the variable cost per unit is 15. So we are looking at the 70,000, which was given in the question. This one is given always. The BEP, you just calculate using the fixed cost formula over the contribution per unit, which is the difference between the selling price per unit minus the variable cost per unit. This is how we could find the BEP, which was computed using that formula. All right, so we are getting margin of safety in units is 20,000 units. So additional units we can produce as a firm is 20,000 units if we are to start realizing or generating profit. All right, so this is about the margin of safety. It's written as MOS. These are cardinal questions that come. So you have that one. So that margin of safety in percentage is equal to margin of safety in percentage. The formula is this one. It's Q, which is budgeted, which is the 70,000, which should be at the bottom here, minus the BEP, then multiplied by 100%. All right. So getting down to this, we are getting 28.57% as margin of safety in percentage. The margin of safety in units was 20,000 units. Now the additional units that they can produce if you had to start generating profit. So we have this one. Then here we are getting this 70,000, even here 70,000. Then we also subtract and divide by that. We're getting the 28.57%. All right. Now you can move on to the other question, because the question is coming from me. So what is important is just about understanding the question. So the other question here says, find the target units to be sold to achieve a profit of 150,000 when the selling price is 20 and the variable cost is 15 per unit. So the formula, given the formula already, so the formula here, these are units to be sold to achieve a profit. So it's fixed cost plus target profit over selling price per unit minus the variable cost per unit. Now, the difference between these two is what we call the CPU, which is the contribution per unit. So the denominator is what we call the CPU, the contribution per unit. All right. So now we get to the question here, this one. So they are going to use it, the target units to be sold to achieve a profit of 150,000. So we are going to simply say it is the So our Q here is going to be fixed cost plus the target profit, then over the selling price per unit minus the variable cost per unit. So we're adding and subtracting here. On top, we are getting 400,000 divided by 5. We are getting 80,000 units. These are units to be sold in order to achieve a profit of 150,000. All right. Is it clear so far, or there are some people?
Sir, sorry, let me just have a look at the formula again for the target units to be produced.
It's the formula is this one here. It is the Q is equal to fixed cost plus the target profit over the selling price per unit minus the variable cost per unit. So this one is also called the CPU, which is the contribution per unit. So it's a fixed cost. So in an exam, the fixed cost will be given to you, so you can check for the fixed cost, then plus the profit that I've stated in the question, then over the selling price minus the variable cost. So here it was indicated that we need to find the target units to be sold to achieve profit of 150,000 when the selling price is at 20 kwacha per unit and the variable cost is at 15 kwacha. So it's just a need of getting down to the formula and then substituting the values that are given there. Okay, so the selling price has been stated, the variable cost per unit has also been stated. So we can substitute here and get the fixed cost is 250,000, which has been given in the question, plus the profit, which is 150,000 over the selling price per unit minus the variable cost per unit. The difference at the bottom here is what we call the CPU, which is the contribution per unit. Okay, is that clear?
Yes, sir.
Okay, so we have that one. So we have the units to be sold to achieve that profit is 80,000 units. So these formulas are not given. I have to overemphasize that these formulas in CVP, they are not given in this management accounting, or even in management practice and management theory and practice, they are not given. Okay, this topic is found in both the courses. All right. Okay, so we have this one. Now, assumptions of CVP, I explained that the selling price is the same for quantity sold and produced. That's number one assumption. Cost and revenue function are always linear as part of the question. Production technology unchanged. Perfect information about product to be sold and produced. Then the limitations from the question I also explained, because for a break-even point, the limitations are a number. The first one is that it changes depending on whichever parameter changes, either the fixed cost changes or the selling price changes, or one of the factors, one of the parameters, if it changes, then it is affected. Okay. And then it cannot be computed when the fixed cost is not given, because we know at BEP, we have the fixed cost over the selling price per unit minus the variable cost per unit. And then it is at this point, it is meaningless because the firm is neither making profit nor loss. So what your work done as a management is equal to 0 because you are not making any profit. So as a company, if you're not making any profit, it will be very difficult to make payments, salaries and wages to employees because you have no profit making. So it is meaningless. You can even close down at BEP. But again, it's at this point, that is only when they ask about the advantages, it will be good because you'll be able to know how you can manipulate. Maybe you can increase your selling price so that you can start making profit. So you can produce more, or maybe you can minimize your fixed costs. Okay, it will be good for planning because you know that we're not making any profit, so you can make adjustments on company operations so that you start generating profits. All right. So this is about what this topic is, what is involved in this topic. All right, unless there are any further questions. So we talked about the formulas to use. There are standard formulas that we need to use. These are only formulas you need to know as we look at the CVP in terms of the contribution. You can't do without it. CVP, that is the CPU, contribution per unit, the break-even point, and then we get into the break-even point in units, in kwacha, the contribution over sales. You need to understand it. Then if one parameter changes, so the BEP has changed also from that, what we found has been affected. So it's different here when the selling price increased. Then the break-even point in kwacha is just break-even point in units times the selling price per unit. And then finding the margin of safety is a standard way. Then getting down to units to be sold to achieve a profit. All right, so this is just about what you need to know as we look at this topic, which is the CVP. Is it clear so far? Okay, if there are no other questions, we can end here for now. But in the next class, we'll be able to tackle as many questions as possible, especially from the exam papers, the previous exam questions that we can look at in the next class. But we can end here for now. What is important is these notes to be shared, and then you go through these the basics, the formulas, and all that. So as we look at the other question in the next class, then it will be very easy for you to follow through.
Are you going to share the video now? I missed some of at the beginning, I missed.
There is no problem about that. The video will be shared. So for those,
Okay,
for those who missed it, don't worry. Everything else, just go through. That everything will be shared. Then we're going to be at par. So that as we look at other questions in the other class, then you will not be behind.